The number one thing that most investors should be most worried about right now is yields on bonds, specifically the treasury market. Because ever since the bottom in 2020, yields on long-term bonds have been rising, which is pushing interest rates up across the entire economy. And recently, the yield on 30-year treasuries has broken out to multi-decade highs. We have to go all the way back to 2007 before the 30-year was at the same level it's at right now. However, if you look at what just happened on Wednesday, August 19th, yields had a sudden and significant drop. The same thing happened with the 20-year and the 10-year. And the reason why is because the Treasury blinked. Scott Bessent, the Treasury Secretary, made a move to stop Treasury yields from rising. And he did this by increasing Treasury buybacks of long-term Treasuries, raising the maximum from $2 billion to at least $4 billion. So I'm going to explain exactly what this is, what this isn't, what the implications are for the bond market, the stock market, and the economy, and exactly what you need to know about this moving forward. As you know, the government issues debt with a bunch of different maturity ranges. So it'll borrow debt that it will pay back in 30 years, 20 years, 10 years, 2 years, 1 year, 6 months, and even as short as 4 weeks. Now, right now, if they borrow new debt with a 30-year treasury, they would have to pay over 5% per year on that debt. But they've been issuing 30-year treasuries for a long time now, which means a lot of their 30-year treasuries have very low interest rates compared to where interest rates are at now. Just like some people today have 2 or 3% mortgages, whereas a person who's a new buyer of a new house would have to have, a 7 or 8% mortgage. We also know that the US government borrows at the very short end and has to pay back that debt within a matter of weeks or months. This would be similar to a person who has a credit card. And obviously, interest rates on credit cards are not locked in for 30 years. Whatever the interest rate is at the moment, the credit card company can change it from time to time. You swipe that card, and if you can't pay off the whole balance, then your interest rate might go up or it might go down in the future as you pay that debt back. And the same thing happens with the short-term debt because, as you might also know, the US government never actually pays off its debt. In fact, the national debt is now over $40 trillion. And the government runs a deficit of trillions of dollars per year. It's at 1.8 trillion almost year to date, which means that every year they're adding to the debt pile. And so anytime they have to pay back any debt that comes due, the only way they're able to do that is by borrowing new debt. So that raises the question, if they were doing debt buybacks, which is essentially just paying off debt early, how were they paying for that? Well, the answer is by borrowing more debt. And because yields have been so bad on the 30, 20, and 10-year, which means the government really can't borrow much at this long end, they're doing all of their borrowing at the short end. In a very real way, this is like if you had a 3% mortgage and you started paying it off early with a credit card that was a variable interest rate credit card, which means that the interest rate on that could go up at any time. Now, if you think that sounds like a bad move, for the long term, it definitely is. They're paying off cheaper debt that doesn't mature for a long time by borrowing more expensive debt that will mature in the next couple of weeks, couple of months, and couple of years. So why are they doing this? Well, they're doing this because yields have been getting too high. Hey, real quick, if you are an active investor and your portfolio is not growing as fast as you'd like, then I would like to give you a free gift. This is something I've been working on for a long time. My team and I put together a portfolio stress test. We looked at the top 6 risks that people are exposed to in their portfolios, many times without even knowing it. And most importantly, what you can do to fix it. So we built this really cool questionnaire quiz on my website where you can input all the information about your portfolio, your investing goals, and then it's going to spit out for you a customized blueprint that shows you where you're currently at and what you need to do to get to the next level. So no matter what is holding your portfolio back and no matter what risks you're exposed to, maybe without even knowing, I want to help you find and fix your vulnerabilities, again, completely free. Once you go through this little 1-minute questionnaire on my website, it's going to send you a customized blueprint to your email, PDF you can download and you can keep it forever. And that's going to give you access to all of my courses. I've created literally hundreds of hours worth of educational content that I used to sell for hundreds, sometimes even thousands of dollars. This is now my free gift to you. You can access it 100% completely free of charge. It's going to give you all the education, all the strategies and tactics that you need in order to fix your portfolio. All you need to do is go through the questionnaire, open up the email, save that PDF, and get to work. So if you'd like to take advantage of this, all you have to do is go to my website, heresy.financial/stress test. The link is in the description below as well. It's heresy.financial/stress test. Plug in your portfolio information, and I'll send you your custom blueprint 100% free. Now, the reason why he said he did this was because of market liquidity. In other words, he's saying, hey, there's stuff happening in the market that shouldn't be, and we want to make sure that everybody knows treasuries are safe to buy and own. And so because yields have been spiking for bad reasons that the market shouldn't care about, we're just going to step in, make sure there's enough liquidity in the market. That way, you know you can buy treasuries because you can sell them at any time. The problem with this is that intervention like this is always very short-lived. Yes, yields on the 10 and the 20 and the 30-year dropped, but all this does is communicate to the market that this is where the treasury is drawing the line. This is where the pain got too great for them, and they are willing to step in here, which means if you are a big player and you have a lot of treasuries that you want to sell, but you've been holding on to them because if you do sell them, it'll push yields up too much, it'll push your bond prices down too much, and you'll take too much of a loss. You don't want to sell them all. Now you know you can sell them, because if those treasuries start to lose value too fast from you dumping them onto the market, some other buyer will step in and put a floor underneath the price. Just in case you are not familiar, this is the exact dynamic that led to the blowing up of the Mississippi bubble under John Law in France 300 years ago. Very quick recap of that story. John Law took the French economy off the gold standard. He made everybody turn in their gold and silver. He issued paper currency that was backed by that gold and silver, plus shares of the Mississippi Company, which owned land in the United States, or what is now the United States. He then started issuing more currency to fund economic projects. And once people realized that there wasn't enough stuff to back up that currency, it started to lose value. They started to try and redeem it for gold. So the value of the currency started to drop. But in order to make sure that the value of the currency didn't drop too much, he realized, hey, I need to make sure that the shares of the Mississippi Company stay inflated. And so what he did was printed new money to buy shares of the Mississippi Company to drive the shares of the Mississippi Company up to keep the value of the currency higher. This doesn't last for long because people realize that means I can just dump all my shares of the Mississippi Company and he's going to have to step in and buy them all so that the price doesn't go down. So because he was willing to step in and buy them up, it actually caused more people to sell. This caused hyperinflation, and the people who got their gold originally were the ones who made off well, like Richard Cantillon, and this is where the Cantillon effect comes from. And the exact same thing, just to a much smaller extent, is happening here. Because the United States doesn't want Japan to sell, and they really don't want Japan to sell because Japan is the #1 holder of U.S. Treasuries. They have over $1 trillion of U.S. Treasuries. They knew that they needed to intervene in the yen bond market, so they offered a backdoor deal with the Bank of Japan so the Bank of Japan could temporarily unload their U.S. Treasuries to the Federal Reserve in exchange for dollars so that those treasuries didn't get dumped onto the market. But that didn't solve the problem, and so now the Treasury has to step in and do direct buying of more long-term U.S. Treasuries itself. This will likely cause even more selling of U.S. Treasuries and even less buying, which means that these buybacks work in the short term but not over any meaningful long-term period of time. This is a Band-Aid that somehow makes the cut underneath worse. Now, a couple of things that this is not doing that I need to clarify because a lot of people are mistaken about this. Number one, this is not QE. Quantitative easing is specifically when the Federal Reserve, the central bank, prints new dollars to buy treasuries from the open market or from the central government directly. QE happens when the Fed's balance sheet rises, and QT happens when it shrinks. So yes, the Federal Reserve is doing a little bit of QE right now, but what the Treasury is doing with these buybacks is not QE. And it's not even Treasury QE because the effect is different than what the Federal Reserve's QE is. When the Federal Reserve does QE, they print newly created dollars, give those to the economy, and in return, they take treasuries from the economy. So the economy is left with more dollar reserves and fewer treasuries. In this case, with what Bessent is doing with the Treasury, is net neutral, net even. There is no net effect on either dollar reserves or treasuries. They are buying back and retiring, paying off early, older long-term debt by borrowing and issuing new short-term debt. So the number of dollars in the economy and the number of treasuries in the economy stay exactly the same. There is no net liquidity increase here. The only change is to the short-term and long-term costs for the US government. But there's no change to the rest of the financial economy. So this is not injecting liquidity. This is not increasing liquidity. This is not printing money. This is not QE in any way, shape, or form. Now, the other thing that people are mistaken about is calling this yield curve control. Yield curve control is something that has happened in the US before. It happened during this period in the 1940s and ended at just about right here in 1952. And this is when the Federal Reserve stepped in to make sure that interest rates didn't rise past a point that they wanted them to. Again, this requires the central bank to print new money to buy enough of the supply of the government's debt to make sure that interest rates are pegged exactly where they want them to be. The federal government does not have the capability to do this themselves because the only way they can push the price of one bond down is by issuing new debt over here, which pushes that price up, and vice versa. Yield curve control itself must be done in conjunction with a central bank who has the power to print currency. The federal government with the Treasury does not have that power. However, there are some effects that look kind of like soft yield curve control, because again, it temporarily and very slightly pushes down the yields of that long-term debt. So the effect is slightly yield curve control, but only on one area of the curve and only a very small amount. You just simply do not have the capability to do outright yield curve control as just the issuer of debt. You also need the issuer of currency in order to do full out yield curve control. Now, this does mean that it will be much harder for the Federal Reserve to do what it thinks it needs to do, unless they were always planning on doing some sort of QE in the near future anyway. Given what Kevin Warsh has said over the last 6 months or so, I don't think this was in the cards, but now there will be quite a bit more pressure on him to do some sort of QE, or at least ramp up the QE that they're currently doing. Because like I said, this is a temporary fix and yields are going to go back up if everything is left alone. And the government by itself can't continue to do this. It needs a buyer. And right now, there are just no big buyers of long-term treasuries. The Federal Reserve used to be a big buyer of long-term treasuries, especially 2021 and 2020. They're not a big buyer of long-term treasuries anymore. They're only buying a little bit of the short end. Central banks around the world are no longer big buyers of US treasuries. We used to have Japan. They're not buying anymore. They're trying to figure out ways to sell. We also used to have banks be big buyers of US treasuries, especially in 2020 and 2021. They're not big buyers anymore as well. So all of the previous big buyers of long-term US treasuries are no longer lining up to buy, which is why there's been so much illiquidity and why the Treasury had to step in and buy it back itself. The only longer-term fix here is to get some new big buyer of long-term treasuries to come in and buy up a ton of long-term treasuries. Historically, that has been the Federal Reserve. And so that is a likelihood here. There is a likelihood that within the next couple of months, there is some sort of emergency or temporary round of QE in order to fix the liquidity issues in the bond market and buy up a big supply of long-term US treasuries. It is not outside of the realm of possibilities at all to see something like this come from the Fed, especially if it's not a longer-term campaign where they say, hey, we're going to be doing this over the course of the next year, 2 years, whatever, especially if it's just, hey, right now, just a one-time thing, we're buying a bunch of these to retire them from the market. But the second possibility, if you've been following this channel for any length of time, you probably already know what I'm about to say, is bank deregulation. Because the reason banks are not the big buyers of long-term treasuries right now is not because they don't want to be, it's because they are literally prohibited by law from buying those treasuries. There's a regulation on banks that makes them buy some US treasuries and then penalizes them for having those treasuries on their books in terms of their risk limits. It's called the supplementary leverage ratio. It's something that was rolled out after the financial crisis in order to make sure banks didn't do anything risky. So they have offsetting regulations, opposing regulations that force them to do one thing and then penalize them for doing so. If the supplementary leverage ratio were to be removed, it would mean banks suddenly could buy all the US treasuries they wanted, and it wouldn't penalize them as far as their risk limits go. So they could lend freely to the private market as well and take up all the risk limits by lending to the private market. This would have the effect of pushing yields down across the curve, especially in the private sector. Corporate bond yields would go down, debt refinancing for small business loans would go down, mortgage rates would go down. And this has already been in the works. It's already been proposed many times. It's just a matter of actually pushing it through. And in an emergency like this, where the government steps in to do extra buybacks, especially if that fails and yields still start moving up, And if the Fed doesn't want to do that QE directly themselves, the Federal Reserve and the Treasury could work together and have an emergency temporarily relief on the supplementary leverage ratio and then work on getting it permanently removed after that. So we'll see what happens. Right now, it worked. Yields went down a little bit, but it looks like it will be short-lived as it will attract more sellers. And this is the line in the sand that they drew and said, hey, we can't really let yields get higher than this. And so if push comes to shove, they will have to take more drastic action. And I will let you know if and when they do. One last note, if you're an active investor and your portfolio is not growing as fast as you'd like, my team and I put together a completely free gift for you. It's called the Portfolio Stress Test. All you have to do is answer some questions about your portfolio and your investing goals, and then it will email you a custom blueprint that will help you fix the vulnerabilities in your portfolio that you maybe didn't even know were there. It's also going to give you access to all of my courses, hundreds of hours of education, strategies, tactics on investing and trading that you need in order to fix your portfolio. Again, this is all completely free stuff I used to charge a lot of money for. Your gift free. To access it, just go to heresy.financial/stress test. The link is in the description below. Fill out the questionnaire, plug in your information. I'll send you that custom blueprint. You can get started. As always, thank you so much for watching. Have a great day.